All right, let's get right into it. Today, we're unpacking something absolutely fundamental. Because look, whether you're trading stocks, crypto, or Forex, you're constantly staring at charts. And those charts, they're speaking a very specific language. In this explainer, we're going to completely decode Candlestick Anatomy. It's literally the foundational language of trading, and we're going to use a simple, everyday shopping analogy to make it instantly click for you.
90%. Yeah, 90%. That is the stark, harsh reality of retail trading. Over 90% of retail traders fail. But here's the secret they don't tell you. They don't fail because they're missing some incredibly complex magical strategy. They fail because they completely skip the foundational mechanics. You know, they're out there trying to sprint before they even know how to crawl.
Okay, let's actually dive into what this means. Your entire edge rests on mastering one core skill, Candlestick Anatomy. Without understanding this absolute basic building block, every single advanced strategy you try to apply later, whether we're talking order blocks, trend lines, or smart money concepts, it will inevitably just fall apart. You absolutely have to know how to read the footprints before you can follow the trail.
Here is our roadmap for the explainer today. 1. The core anatomy. 2. The psychological story. And 3. The institutional wick trap. Section 1. The core anatomy. So every single candlestick on a chart, whether you're zooming in on a fast 1-minute time frame or zooming way out to a massive daily chart, is made of two main visual parts. You've got the body, which is that solid, thick, colored part, and then you have the wicks, some people call them shadows, which are those thin little lines extending out from the top and bottom of that body. To read this mechanically, you really just need to remember 4 letters, OHLC. That's open, high, low, and close. These are the 4 key price points that map exactly what went down during that specific time frame. Now, what's really interesting about this is how the open and close positions actually flip depending on who won the session. Let's look at the bullish candle first. That's usually colored green or white. Because the buyers won and pushed the price up, the open is right at the bottom of the solid body, and the close is at the very top. It climbed, right? Now flip that for the bearish candle, usually red or black. Because the sellers dominated and shoved the price down, it opens at the top of the solid body and closes at the bottom. But here's the kicker. Notice the thin wicks. The high and the low remain exactly the same for both. The absolute highest and lowest extremes reached during that session are always represented by the very tips of those upper and lower wicks, totally regardless of who ultimately won the tug-of-war.
Moving on to Section 2, the psychological story.
Let's translate this into something we all naturally understand. A trip to the supermarket. Imagine a single candlestick is just tracking the price of one specific product on a supermarket shelf over a single day. In the morning, the store opens, and the product is priced at $10. That's our open. Suddenly, bam, there's a midday rush. Word gets out, panic buyers flood the aisle, and that insane demand drives the price rapidly all the way up to a high of $20. But at $20, shoppers realize, whoa, this is way too expensive. The demand just vanishes. So sellers start aggressively dumping the product to clear out their inventory, plunging the price all the way down to a bargain low of $5 in the afternoon. Finally, right before the store closes up for the evening, level-headed buyers step back in, stabilizing the price so it finishes the day at $15. That is your close. 10, 20, 5, 15. Open, high, low, close. It's just human behavior, panic, greed, and bargaining, creating those exact data points.
So when you look at the final candle generated by all that supermarket chaos, you aren't just looking at a colored box anymore. You're looking at the footprint of human emotion. If you see a massive, solid body with almost no wicks, well, that tells you instantly that one side completely dominated the other from the opening bell right to the close. Total control. But what if you see a tiny little body trapped right in the middle of these huge, long wicks stretching up and down? That screams absolute confusion. It means the market whipped prices violently in both directions, but ultimately nobody could agree on anything, and they closed right back near where they started. Pure indecision. And that brings us to Section 3, the institutional wick trap.
You know, most everyday retail traders look at a long wick on a chart and simply think, oh, the price was rejected. But smart money? They look a lot deeper. The crucial point here is that a long wick actually represents hidden price action on a lower time frame. Think about it. If you're looking at a 1-hour candle and you see this massive, long wick shooting out the top, it just looks like a simple line. But if you were to grab a magnifying glass and zoom into, say, a 5-minute chart during that exact same hour, you wouldn't see a straight line at all. you'd see a massive, multi-candle upward trend followed immediately by a violent, aggressive crash right back down.
Let's walk through how this actually builds into a deliberate trap, step by step. Why does that sudden upward trend and violent crash happen in the first place? Well, it's all about liquidity. Massive institutions and central bank algorithms need a huge amount of buyers if they want to offload their multi-million-dollar positions. They literally can't just hit sell without crashing the market on themselves. So, step 1, institutions deliberately engineer a sudden upward spike, pushing past recent highs to make it look like a major breakout. Step 2, everyday retail traders see this giant green movement, they feel intense FOMO, fear of missing out, and they rush in, placing thousands of buy orders. And then, step 3, the trap springs. The institutions now have the eager buyers they desperately needed. They instantly dump their massive institutional sell orders directly into those retail buys. Step 4, that immense selling pressure causes the market to reverse violently downward. The retail traders are completely trapped, their stop losses are triggered, and all that remains on the 1-hour chart is a long upper wick, essentially a tombstone for trapped retail money.
So never look at a candlestick as just a static, boring drawing ever again. It is a dynamic, fluid map of liquidity, orders, and human emotion, exactly like shoppers fighting over a bargain at the supermarket. By mastering these simple OHLC mechanics, you can actually read the story of the battle. But here's the real question I want to leave you with today. Are you ready to see how thousands of these individual footprints combine to build the major structural walls of the market, those powerful areas of support and resistance? Because, let me tell you, that is where the real trading edge is born. Thank you so much for joining me for this explainer. Keep studying those charts, and I'll see you next time as we continue to decode the market.